Home prices are soaring to record highs, and wealth is more concentrated than ever before. And millions of Americans are left wondering, are we on the verge of another collapse? The last time housing prices hit unsustainable highs, it ended in disaster. But will history repeat itself? Or are we looking at a market that's completely different? What are the triggers that lead to a crash? What housing crashes have happened in the past?
There are fears the sell-off will continue on Wall Street.
Soaring gas prices, falling home prices, and rising unemployment.
And most importantly, could the housing market crash again? To answer that, I studied every single housing market correction or downturn for the last 114 years, starting from when the Federal Reserve started monitoring our monetary policy. We traced key economic events that led to housing price shifts and searched for patterns that might lead us to the next housing meltdown. For starters, we have to know, how do markets crash? A crash in any market, a housing market, stock market, even the farmer's market, comes down to one fundamental relationship: supply and demand. Supply is the amount of something that is available for purchase, and demand represents how much people want that thing. When supply and demand are in balance, prices historically will remain stable. But when one begins to outpace the other, we begin to see prices shift. Let's say you're at a farmer's market and you need a banana because guess what? Your potassium, it's really low. Or you just really like bananas. But demand is now higher for those bananas, which means you may be willing to pay a little bit more, you and the other 4. But what if there are only 5 bananas and 4 other banana-loving buyers besides you? And if there are only 2 bananas left with 10 willing banana buyers, well, now demand is high and supply is low, so the price will surge. When has housing crashed? Over the past 114 years, we have seen 4 major corrections or crashes in the housing market. A correction is defined as a moderate price drop of about 10% or less. In 1929, we saw the Great Depression begin, fueled off of the Roaring '20s. Credit was easy, people were spending, and the federal funds rate was very low. When the federal funds rate was raised, however, buying power was diminished, foreclosures began to increase, and home prices would plummet over the next 4 years by 35% or more across the country. Unemployment was rampant, dollars were few, they were even using seashells as currency in some states as they did not have enough dollars in circulation. It was a weird time. Moving forward to 1953, we're in the post-World War II. We saw another housing boom that was boosted by the GI Bill that allowed soldiers coming home from war to buy up more properties than ever before, and a moderate to low federal funds rate all up into about 1952. However, in 1953, we would see about a 7% housing price correction, with the federal funds rate raising its rates once again, unemployment beginning to creep up, and foreclosures beginning to spike post-World War II. And in 1990, building was at an all-time high. And with money moving around, people buying homes, people buying cars, inflation began to creep up, and the Federal Reserve stepped in and increased its Federal Reserve rate quickly and sharply. Mortgage rates would spike to 10 to 11%, and home prices would see a drop of 2 to 4% across the nation, with higher unemployment than normal and foreclosures beginning to uptick. And that brings us to 2008. The most significant housing crash in modern American history. In 2001, President George W. Bush loosened monetary policy. This led to an explosion in lending, more specifically, mortgage lending. Also fueled by our release from the Glass-Steagall Act in 1999, which was an act we've had for 67 years, that ultimately prevented banks from getting involved in certain riskier investments, set the stage for banks to start issuing risky mortgages. They would ask you, how much do you make? And you could tell them how much you made, and they would just believe you as long as you had a decent enough credit score, and there was your pre-approval to go buy a home. Demand soared and supply followed. Investors began to flip homes at record highs, builders were expanding rapidly, and the market was white hot. By 2006, though, we see a familiar face begin to step in: the Federal Reserve. They begun raising rates quickly and significantly. The federal funds rate jumped from 1% in early 2001 to 5.25% just 3 years later in 2004. And this hurt 3 specific groups of people. 1, new home buyers. Higher rates priced many people out of the market, lowering demand significantly. Number 2, home builders. As they were building at record paces, they would begin to slow down drastically as their supply was beginning to sit. By the end of 2006, borrowing costs became unsustainable, demand cooled, supply rose, and then the tipping point. In 2007, 25 subprime mortgage lending companies would file for bankruptcy. Panic would ensue, bank failure would begin, investors would pull out of mortgage-backed securities, and foreclosures would skyrocket. By 2012, over $7 trillion in home equity had been erased from the housing market. So the big question in 2025 and beyond, can it happen again? The first pattern we have to look at is the most important: supply and demand. Historically, housing crashes have followed periods of high supply and high demand markets. And then something will happen, leaving the supply high and dry and bringing demand to near all-time lows. The second pattern we can see is the Federal Reserve's role in it all. The Federal Reserve controls the federal funds rate, which doesn't ultimately directly control mortgage rates, but influences them heavily. A pattern emerges in these past downturns where rates were lowered to fuel intense demand, usually prior to the crash, then sharply increasing those rates before the correction or crash would ensue. The Fed raising its rates, raising mortgage rates, quells demand quickly, and if left with high supply, can lead to that crash or correction. And third are the economic indicators: foreclosures on the rise, unemployment, and financial strain as a whole usually leads to housing downturns. So as of now, are we seeing any of these three patterns? Today, inventory remains constrained as we just peaked over 1.1 million homes in February of 2025. We had well over 4 million homes pre-2008 housing market crash. Many economists also agree that we need anywhere between 2.5 to 3.5 million homes right now to support the housing market, and we're nowhere close to that. So supply is low. Demand is also low, but with so many people that have equity that's been built over the last 3 years and savings accounts that have been building for decades, many are still ready and willing to buy when the homes are available. It's also worth noting that resale inventory, homes that people are actively living in and selling, are actually still at near all-time lows, with new construction builds facilitating more than 50% of the current inventory in our country. And those new construction homes are starting to sit longer than builders would like. Two, our friends the Federal Reserve. Since the spring of 2020, post-COVID-19, the Federal Reserve lowered its federal funds rate to 0%. Money was cheap, borrowing was great. This fueled a crazy amount of demand that we all saw from 2020 into and through 2022. 2023, though, would lead to the Federal Reserve increasing its federal funds rate quickly and sharply, moving up over 4% in under 12 months, peaking at 5.33% in December of 2023, leading the mortgage rates being up and above 6.5% to 7% for the greater period of that time. The Fed raising its rates so quickly and significantly, all while having historically low rates just before, rings similar to a Great Depression-like pattern where we saw very, very cheap money, leading to economic booms, only to be halted by a federal funds rate hike, which would leave a lot of people feeling high and dry. And the third pattern, are we seeing any economic indicators, foreclosures, unemployment, or anything that could signal financial tightening? As of January 2025, the U.S. unemployment rate stands at a very low 4.0%, slightly higher from the 3.8% just 12 months ago. And foreclosure activity has increased slightly, with 30,816 homes filing for a foreclosure in January of this year. And while that's an 8% increase from December 2024, it is actually a 7% decrease since last January. With the Mortgage Bankers Association stating, delinquency rate for mortgage loans currently on 1 to 4 unit residential properties is only at 3.98% for all loans. And that's anybody that's 30 days or later on paying their mortgage. And if we look at a foreclosure start graph as of today versus 2007 and 8, we can see the stark difference in the number of homes that are actually entering foreclosure versus then. So are we heading toward another housing meltdown, or are the ingredients not quite there? Some key ingredients are present, but the crucial difference today is that supply remains constrained, lending standards are much more strict since 2008, and due to inflation and other regulatory factors, builders aren't building enough. However, we do see a pattern with the Federal Reserve and its funds rate leading to higher mortgages and a more constrained demand in our housing market. However, if affordability continues to decline and economic conditions continue to worsen, the market could experience a correction, or possibly something more severe. So are we heading to another housing market crash like 2008, or are we on the path toward a different type of financial crisis altogether? With record highs and record lows across the board in many financial sectors of the housing market, it's very easy to see something's off, but will it cause another crash? We'll have to see. Hit subscribe to stay up to date on all things housing and real-time data, and have a great day.